Hello, how are you doing? My name is Gonzalo, you can call me Gonzi, and I'm going to be explaining technical analysis, types of charts, and candlestick patterns just very quickly. I'm not going to do a very elaborated explanation. This is more for a starting point of view where we start just talking about a little bit of the basics before we carry on doing too complex, so we can start building the blocks at the beginning and then going from there step by step, because trading is always developing a skill and it needs to be built in blocks so that it can carry on being developed. So, as we're talking technical analysis, this will be the episode 1. We got types of charts, candlesticks, and candlestick patterns. This content is intended to provide educational information only and therefore should not be constructed as an individual or customized legal tax, financial, or investment services. As each individual situation is unique, qualified professionals should be consulted before making legal, tax, financial, and investment decisions. Trading on margin Trading on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade any asset, you should carefully consider your investment objectives, level of experience, and risk appetite. The educational information provided in this channel is used for educational purposes only and not for any certified or certification purpose and will not prepare any user to be accredited for any license in any industry. It will not prepare any user to get a job. Past results are not a guarantee of future performance. The information is presented without consideration of the investment objectives, risk tolerance, or financial circumstances of any specific investor and might not be suitable for all investors. Investing involves risks, including the possible loss of principal. The possibility exists that you could sustain a loss in excess of your initial investment. You should You should be aware of all the risks associated with trading and seek advice from an interdependent financial advisor if you have any doubts. Any opinions, news, research, analysis, price, or other information contained on this channel does not constitute an investment advice. We do not accept liability for any loss or damage, including, without limitations, to any loss of profit which may arise directly or indirectly from use of or reliance on such information. So this will be the disclaimer. So technical analysis. Technical analysis is the analysis of a certain asset using tools and techniques that enable us to forecast future price movements. What does that mean? It means basically that on each asset they have certain patterns to which with technical analysis we can start recognizing more and more. The more experience we have, the more we can recognize each pattern that a certain asset makes, and therefore with that in perspective we can forecast where the price is going to move and therefore capitalize on those movements. Some examples of technical analysis are price action, levels of support and resistance, indicators, candlestick patterns, smart money concepts, and many more. Types of charts. There are various types of charts. There are line charts, bar charts, Japanese candlestick charts, and many more. We're only going to mainly focus on the candlestick charts, and the reason for that is because it gives us a best visible price movement over the term in a determined time frame. So when we analyze charts, we have to select which time frame we're going to work on accordingly to our strategy. This means that we use different time frames to invest on an asset depending on our risk appetite and goals. Let's start with a line chart. In a line chart, the line is formed by the close of a certain time frame. That can be 10 minutes, 1 hour, 4 hour, 1 day, week, month, year, etc. At the close of that time, the line is formed, and the new point at which the line is going to be formed will start to move. So this is the weekend, so there's no movement, but we could go to crypto. and we could see that the line is moving. And if we go even to low time frame, we can maybe search for more volatility at the moment. Well, but you get the perspective. At each close of each candle, the price will be formed in a line. And that's what it is. A line chart is basically it just shows us the close it just shows the point at which the price closed at that specific time. So in 5 minutes, this is a line chart of 5 minutes. We go a line chart of an hour. You can see where the price is going up and down. Now let's talk about bar charts, which paint the open, high, low, and close of a determined time frame in a determined asset. That allows us to obtain a better understanding of the price movement action behind it. So let's say on this day, it's a bit harder to see, but I'll get to the best point in a minute. So let's verify draw it. So a line chart is just basically a line that gives us the open and the close of a certain time. So this is the daily, and the daily just says that the price opened at, let's say, 0.62 New Zealand dollars and close at 0.65 New Zealand dollars. And that just means that this price movement is started low, went a little bit low, to which gives it the low, so it shows the open, shows the low, went a bit high, shows the line, and then it shows the close. And this is just what the bar chart is. This gives us a better understanding of the price movement at this time frame, which is the day. As you can see, if you can see, it's a bit harder to see, but you can see around here it opened, went down, and then went up, and it closed. So this is the price movement for the day. Same thing for the 4 hour. You can see it better. As you can see, we go open, up, high, down, low, and then a close. And then we have the different candlestick colors, which is when the close closes higher than the open. When the close closes higher than the open, the bar is green, and when the close closes lower than the open, the bar is red. This is just to differentiate the bullish from bearish movements. So when it's green, it's bullish, and when it's red, it's bearish. Now let's talk about Japanese candlestick charts, to which are similar to bar charts. However, they give us a better representation of price movements, giving us a better ability to read price action. The reason for that is because we can see the whole body between the open and the close of each candlestick. And that gives us, I think it gives us a better view of the price movement. Bar charts gives us the same thing, but it's not as easy to see as on the Japanese candlesticks. And therefore, I think Japanese candlestick charts are better to analyze and forecast the next price movement. The candlesticks gives us the open, high, low, and close. If the price closes above the open, the candle will be green, as I've told you on the bar chart, and it's a bullish movement. Conversely, if the candle closes below the open, then the candle will be red and bearish. As you can see, these are all green. This is a bullish move, they're all green. This is a bearish move, they're all red. This type of chart is the mostly used worldwide, especially from technical analysts, to make their analysis and put in their investment into their preferred assets. I think, in my personal opinion, I think that these candlestick charts are the best to analyze the markets. And the reason being because we can identify levels of support and resistance, and this will allow us to capitalize on the price movements. It broke, and this is a level of resistance now. Support, 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 broke, and now it's resistance, 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 and carry on going. And then we have another one here, and then another one here. As you can see, this is a technique of support and resistance, to which I'm not going to talk about on this video, but I'll eventually talk about these levels of support and resistance. Let's talk about candlesticks. A little bit of a review of what we just talked about to explain the open, high, low, and close of the candlestick. So on the bullish candlestick, we will get the open at the bottom, to which consequently will give us a low. Not always, but still. Which consequently will give us a close, a high, excuse me. And completing a close. And this is a bullish candlestick. Why is it a bullish candlestick? Because the close closes higher than the open. Now let's talk about the bearish candlestick, to which gives us a close, open, excuse me, a high, a low, and a close. And this is a bearish candlestick. So this is the basics. We spoke about candlesticks. There's a particular topic I would like to speak about candlesticks, which are called the candlestick patterns. And the candlestick patterns are patterns on the charts to which we can identify, and throughout history have reacted to the market in a specific way, where we can identify certain zones, and in conjunction with these candlestick patterns we can use it in our advantage to forecast the next price movements and capitalize on it. There's various candlestick patterns, to which I've only identified a few of them that work best. Well, at least have worked best with me. I use it for my entries, exits, take profits, and to forecast next price movements. So the main candlestick patterns that I use are the bullish and bearish engulfing pattern, morning and evening star, hammer and shooting star, to which I will show you right here. So we got a hammer, to which there was an open, a low, to which came a little bit further, and the body is to be smaller than the wick, and the close needs to be higher than the open, and this is called a hammer. Where would we like to have this hammer on? We would like to have this hammer at areas of support. As you can see, there's a hammer here. It's red, to which signifies it's a little bit weaker than the green hammer, but still it gave us an entry to go higher. There's another hammer here. Red hammer, two red hammers. There's a green hammer here, a red hammer here, and another hammer here. And these are just points that helps us identify and forecast where the next price movement is going to go. There's another one here, by the way. Then we have a shooting star. which is the opposite of a hammer. So we have the open, gives a wick height, and then a close. And the close needs to be lower than the open. Where would we like to have shooting stars? At resistance levels. This is a kind of a shooting star. See more. Let's see if you can see any more. There's another shooting star, which came from this support that transformed into a resistance area. There's another shooting star there. Over here. Then we got the bullish engulfing and the bearish engulfing. So basically, the bullish engulfing is when we have a bearish candlestick, and the bullish candlestick will engulf, eat all of the bearish candlestick, and this is a price movement to go higher. Conversely, we got a bearish engulfing, which is the same thing as the bullish. However, there's a green candle first, to which the bearish candlestick will engulf, eat all of the body of the bullish, and this is a bearish indication movement. Then we have morning star and evening star. So morning star is a bearish candle with another bearish candle, to which the bullish candle after these two is a 3 candlestick pattern, and the bullish candlestick will eat the previous bearish candle plus close more than half the first bearish candlestick, and this is a bullish movement, morning star. It's the morning star of the sun. Came from a night, went to the day. The same thing as the evening star. We got a bullish candlestick with another bullish mini candlestick. It could be a doji as well, doesn't really matter. These are the 3 candlestick patterns. And the bearish candlestick will engulf that middle candlestick plus more than half of the bullish candlestick, and this is a bearish movement. Therefore, evening star, when the sun was going up and now is coming down, making it evening. Now let's talk about a couple of other candlestick patterns, which we got the bearish harami, which is where on the bearish harami we got a bullish candlestick pattern, to which engulfs the next bearish candlestick. However, in this situation, to be a bearish harami, the first bullish candlestick must engulf both the body and the wicks of the bearish candle, and they should be in between the body of the first candlestick. And this is a bearish harami, meaning that the price should be going down. We got bullish harami, which is a red candlestick over here, and it should engulf all of the body and the wick of the bullish candlestick, which is what happened here, and this is a bullish movement. Then we got doji, which is more renowned to have indecision in the marketplace. It's just when the bulls and bears don't know where the price is going to go. Then we have tweezer tops. Tweezer tops usually mostly found on resistance or mostly effective on resistance is when the price hits a certain resistance level and performs two more or less dodges with wicks more or less the same high, making it tweezer tops. And this is usually bearish signal. Same thing as tweezer bottoms is when two candlesticks are more or less the same size and the wicks stay at more or less at the same level. This is mostly found on supports. You can find it on resistance as well. However, this is most a signal to which we should be using it at support levels. And this is a bullish signal. Now we talk candlestick patterns. So this is a tool that we should be practicing and identifying on the charts. So let's just go through, use the Japanese yen with USD, USD with Japanese yen. Let's identify some candlesticks. Here we go. What's this? We got Morning Star. Morning Star. Then we got bullish engulfing. There's an evening star here. There's a bullish arami here. Bullish engulfing. We got a red hammer. We got a morning star. Bearish engulfing. Bullish engulfing. Evening star. Shooting star. Together with bearish engulfing. Bearish engulfing. Morning star. And we can carry on doing this and this. The more you practice, the more you get used to it at identifying these candlestick patterns. However, we're not going to be identifying, we shouldn't be identifying the candlestick patterns everywhere because you will end up identifying them everywhere. However, we will need to use some sorts of support and resistance and use them in conjunction with the candlestick patterns. So we trade. So we form a resistance there, it came back down, it pulled back, it went, it hit another resistance and it formed shooting star, to which the price moved downwards. Then it hit this area of support and it created a morning star, and the movement went up, and the bearish and the bullish arami as well. Same thing here. We got another area of support. There's a bullish, it's not bullish arami because it's not eating all the body and the wick. However, we got bullish engulfing over here, and the price movement went up. These are just a few examples of identifying where we should be having bullish and bearish movement, to which we need to use it in conjunction with tools in order to have a higher probability of forecasting the price movements. This is it for now. Practice what you've learned. Go a little bit through the line charts and see what you think about the bar charts as well, to make it to build the foundations of how to analyze the charts and use it in our advantage. So please practice what you've learned. Read the notes if you've taken them, otherwise just watch the video, to which I think this is pretty basic concepts for you to learn. It's a very good foundation from where to start. This is a continuous development skill. Learn, test, apply, modify, and keep growing, so that you can always keep growing as a trader, as an investor. And lastly, thank you for watching. Click the likes button, s'il vous plaît, and I hope I see you again. Thank you very much. Take it easy. Take care. Bye bye.